Go ahead, Katishia.
Okay, let me figure out if I can. How do I unmute myself? All right, can you hear me?
Yes,
Okay, and can you see the screen still?
I,
Uh,
I can see you.
okay, you can't see. All right, hold on. Let me see if I can share. Um, hold on. All right, let's try this again. Anyway, I'm Katishia Gallishaw, KG Virtual CFO. I love Common Capital. Common Capital, the connection was made with Common Capital. I was on the financial board, financial committee of a nonprofit organization in Springfield, and we were launching child care development program. And at that time, being a nonprofit and not having access to the traditional funds, we went to non-capital, common capital, and we were able to get funding to launch that that service for school-age children. We ran it through our community center for quite some time, and ever since then, kind of I've been hanging out with Common Capital, running, helping with webinars and serving their clients with bookkeeping support and things like that. And it's just been an absolute joy and pleasure. It's been a number of years. I can't remember how many, and I don't want to count because I don't want to feel old. So we'll just leave it at that. I absolutely love Common Capital. Great organization to serve with. Let's see if I can find my slides. For some reason, technology tech is not cooperating. I dropped some slides in. I dropped a handout in the chat, and I want to see if I can share my slides. Let's see. We're gonna, today is session one. Can you see the slide now? Are we profitable? Reading the income statement.
Yes.
Perfect. All right. So we would love for this session to be very interactive. We know we got some financial experts in the room. So I don't want to be the only one talking. And then you, as business owners, you're experts in your business. So we're going to take some financial knowledge and your expertise in running the business, kind of blend them and see how we can make an understanding of our numbers and see how they are useful, not only for just getting loans, not only just for filing taxes, but also useful in making business decisions. So this is session one of a three-part series discussing understanding your business numbers. In the first session, we're looking at the profit and loss statement or income statement or P&L, used in several, has several names. And if you're in the nonprofit world, it could be called the statement of activities. And the number one question that we're asking today is, are we profitable? Right. And so to start off, business owners, when they usually come to me, they're killing it. They're like the business. I would love to know the types of businesses that you all run as well. That would be great. And Emil, I can't really see the chat, so if you can monitor the chat, that would be great. So I know someone makes cakes. So yeah, they'll come to me. They say, "Hey, I'm making cakes," or "Hey, I'm a consultant." "Hey, I run a nonprofit," or I have a restaurant. Working the business, it seems to be growing. I seem to be making money, but I don't really know if I'm profitable. I don't really know if I'm making money. I don't really know what my numbers are. And so that's usually the starting place where we get in and we get to understand, help the client understand what the numbers mean and how the numbers can be used in the financial statements to make business decisions. And so usually they come with a feeling, with a vibe. It's like, hey, I know I'm making money, but I don't feel like things still feel tight. And so we dive into the numbers and see what those numbers are saying and see if there's any decisions that we can make to, first of all, bring clarity, but then second of all, be empowered by the numbers to make business decisions that can move the business forward and grow if that's, the desires. So, um, this series, we're just gonna answer three different questions along the way. Today, the question is, are we profitable? But the next section is going to be looking at the balance sheet. We're going to answer the question, are we healthy? And that reveals, the balance sheet reveals what the business owns as well as what it owes and the net value or the net worth within the business over the life cycle of the business. So that's session two. Sneak peek to session three is, are we sustainable? Looking at that cash flow statement, money coming in, money coming out. So we'll know that there's transactions, all the different things that you do as you operate and run the business and different things that you're expending, different money that comes in and different money that goes out. They may go on different statements. Everything that you need to know about your business is not just going to be on the P&L. The P&L predominantly is going to show profitability, and profitability, to be truthful, fundamentally, it's a function of the IRS code. The IRS code of regulations tell us what income is taxable, what revenue is taxable, and what's not taxable. IRS code tells us what expenses are deductible expenses and what are not deductible expenses. So, for instance, for meals and entertainment, you may spend $100, but only 50% of that from a tax perspective is deductible. So the tax code is going to tell you what your profit is, and your P&L can tell you what you owe for tax perspective, and it also is a performance tool. This statement, the P&L basically tells you how you performed in your business for that particular period. You can run it from a monthly basis or a quarterly basis, annual basis. You can compare them and see how things changed from period to period, and do that analysis as well. So those are the three questions. Those are the three sessions, a little roadmap of where we are going. But today we're going to look at the P&L. Any initial questions or comments before we dive in? All right, so I invite you, if you have access to your numbers, I know you may not have your numbers before you, but if you do have access to your numbers, I invite you to grab them. If you have access to your QuickBooks or Wave account, or if you have last year's tax return, or if you have some kind of financial statements that shows what your numbers are for the business, I invite you to grab it, right? To take what you are learning today and in real time run these numbers for your own business, right? And run these. We're going to look at some metrics and some KPIs and see what those are for your business, right? But if you don't have any of that, and for the sake of just a general discussion, we are going to be discussing a fictitious business called Bright Path Consulting. It's owned by Mary Chen, and it's an HR consulting firm out of Atlanta. She has 8 staff members, 5 consultants, 2 project coordinators, and 1 part-time bookkeeper. This is the 4th year of operations, and she has a mixed revenue model. So 60% of her revenue is consistent monthly retainer clients, right? So each month is that predictable stream of revenue. Each client knows what they're going to be billed each month. So that way she knows what's coming into her business each month from retainer clients. That's 60% of her revenue. 40% is from one-off projects, right? So that's not as predictable, but it is still a substantial part of her business model. So I invite you to think about your different revenue streams. Is it all coming from one type of product or service, or do you have a mix? And what is that mix, and what does that mean to you, right? And what does that mean as far as growth? So, for Bright Path Consulting, her question is, she had a good year, but she still feels kind of tight. So, did she really have a good year? Her calendar's been filled. She's booked and busy. Clients are renewed. New projects came in, but she still wants to know, where did the money go? That's the question that I usually get all the time, and that's the question that she has, and we are posing to us today as a form in discussion form. The financials will tell us the answers to those questions. Income statement. What is it and what it does? I dropped the session notes and the handout in the chat. That could give you a reference of some of the definitions that we'll go through today. It also gives you her P&L for year 4, as well as a comparative to year 3. Also has some other kind of homework or things that you can do on your own. But what does the income statement or the P&L show? It shows revenue earned. It shows costs incurred. That's an accounting term. It shows profit and loss, right? For a specific period of time. What it answers, did my business actually make money that period? It's a scorecard of business performance over time. It will not show you cash in the bank. It will not show you what you own versus what you owe, assets versus liabilities. You're not going to get that from the P&L. It will not show you if you can make payroll next week. Those are all different documents, but the P&L is going to show you profitability. You can use it to estimate what your tax is going to be. You can use it to estimate what your quarterly taxes should pay into, and you could use it to determine profitability. Banks and other financial institutions look at that as a measure of performance. So yeah, it's important to know what the income statement shows and what it does not show. Any questions or comments? And also, I guess an interesting question, maybe Emil, if he's willing to chime in, and those other that's been working with lending institutions, when they ask for financial statements, how many years of financial statements do you usually ask for? And, kind of what are you looking for from that perspective? I don't know, Emil, if you want to jump in on that.
Typically,
Mhm.
oh, this is Earl. Typically, we would request 3 years financial statements, preferably tax returns. I would also comment just based on what you said about the income statement. Um, Typically, the way that we look at things, at least, the income statement may in fact show profitability. It depends, quite frankly, if it's, based on accrual, right? Accrual accounting versus cash, which is very important because the income statement is kind of a tricky document. It may in fact reflect profit, but it may not be actual profit. Obviously, it goes to some of the other statements that you refer to, cash flow and certain assumptions that you make. But just my quick comment. Sorry.
And Earl, what organization are you from?
Capital for Change.
Capital Virginia. Okay, where's that based out of?
We're based out of Connecticut, actually.
Awesome. Okay. All right. Thank you. Thank you. So usually 3 years of financial statements and tax returns. Emil, does that jive with what you all usually ask for and what you
The
look at?
thing for us, if someone is applying for a loan, if for us to make a decision, we want to see if it is an existing business. So we will look to 2 years tax returns, uh, financial statement, which is include the balance sheet and the profit and loss for the last 2 years. And if it is during the existing year as well, we want to see up to date the financial reports. For our existing borrower, we will follow up with them and we request to send us their quarterly report, which is we will always compare or we always see the financial report, the profit and loss, and the balance sheet, because both of them, they can give us a good picture.
Love it. I love it. Thank you. Thank you for sharing. Yeah, so and that's a good point. Yeah, having your financial statements up to date and consistently reviewing them to see how the business is going and how the business is performing. And as Earl alluded to, profit, again, to connect it to what I said earlier, it's a tax computation. So it may show profitability, but it doesn't show cash, right? It doesn't show what's in the bank. Profit and cash are not the same thing. Revenue, profit, and cash. They're 3 different numbers completely. So the P&L could be a great performance number, a performance statement, but it does have limitation. And Earl alluded to this, but we're going to talk about it as well. There's some numbers on there that are non-cash numbers. For example, depreciation. That's something that reduces revenue in terms of expense and reduces the profit, but it's not actually money out of the bank. You purchase an asset, and from a tax perspective, typically, generally, that the cost of that asset is spread over the useful life of it, depending on what the tax code says. So that was a high level overview, and we're going to trace revenue, money coming in. Again, revenue is what you earn from services. So there's different money that can come in. If you receive a loan, that is not taxable revenue. That's money coming in. It's cash in the bank, but it's not revenue. If you personally invested money in your business, put your personal funds, that is not revenue. That's not taxable revenue. Those go on separate statements. So you have to know that revenue, what revenue is in terms of what is taxable in terms of the services or the products that you offer and the sales that you received from them. And if you follow this map here, then from there, we want to narrow in to the cost of services. What does it cost you to deliver that service to your customer? Or what does it cost you to bake that cake? Or what does it cost you to create that other product, right? Nail in on those direct costs, cost of goods sold or cost of services that it takes you to deliver that. Getting that number in your head and nailing that down is very key and critical to growth, because that's going to show you from a profitability perspective if you are charging the right price. It'll also help you to see how much an increase in, now we're in dealing with inflation and we were dealing with tariffs and things like that. You need to know how much those changes in the overall business climate may affect you and your profitability. So drilling down what it actually costs you to deliver that good or that service is key and critical to your financial viability. If you take revenue and reduce it by those specific costs related to your services or the cost of goods sold, then you get a number that's called gross profit. That's what's left from delivering your work. You have now this money that's left to pay your operating expenses, the other costs that are not directly related to delivering your service or good, but are related to running your business. It could be your rent, it could be your insurance, it could be marketing. Those are other operating expenses or OpEx, right? So you have revenue that came in, you had to pay the money to actually deliver what you served and what you provided to your customer. They gave you gross profit. Then you have other costs that comes. I mean, I remember during COVID, where sales, oftentimes business owners lost 50, 75% of their money, right? Or their revenue, but they still had these fixed costs, these operating costs, and they had to determine, hey, how are we going to pay for these costs if revenue doesn't come in? And you deduct that and you get operating income or profit from the core business. I think I see a question here. The question is, could you provide an example of how a service business could calculate costs if physical products are not a factor? Yep, we're gonna get right into that. I believe it's coming up in a minute, but it would be those costs that are directly related. So if you subcontract and use other consultants to offer your services, or if you have other software that you use to deliver your services. For me, like for a bookkeeping firm, I pay my bookkeepers their direct costs of services, the CPAs that I use to prepare tax returns, their costs of services, software, the QuickBooks, the Wave subscriptions, those are costs of services. Also, like that merchant fee. I run a virtual practice, and most of my clients pay electronically. Can't remember the last time I received an actual physical check. So that merchant fee is my cost of service because it's integral to my business model. So that's some of the examples of cost of services. But we can get into that a little bit more. Oh, you're welcome. And it's important to see that at each of these kind of curves is a decision point. So when money comes in, you decide, you make a decision on how, what it will cost you or what particular services that you would use to deliver that product, and also operating expenses. Those are decisions. So we see from the financial institutions and for us numbers people, we see the numbers, but you know the story behind those numbers, and behind those numbers are individual decisions. Someone said that you make 50,000 decisions a day or something like that, right? And so related to your business, who knows how many decisions you make each day, but each one of those decisions are usually reflected somewhere in a line item in your business on one of the financial statements.
And it's also important, Earl, again, to
Yep,
understand just on a higher level, right? How what type of revenue you receive. So when you book a sale, you can book a sale in a variety of ways. It could be cash or it could be credit. The implications are quite different in terms of a cash perspective. And that also has an impact in terms of your overall profitability because it goes to the point that you said that you just responded to certain fees that you have to pay if you're, getting digital payments. It also goes to really how much money, cash, if you will, do you have to run? So just another point.
absolutely, absolutely. And following along in our example, for example, to your point, this particular business has two revenue streams. They have retainer fees, which is kind of fixed, and projects, which are kind of one-off or variable. I remember working with a client, they had an actual physical brick and mortar business, and it was important for them to track the sales from the brick and mortar as opposed to the sales that they sold for online through their online e-commerce platform. And it was also important for them to track the sales that they had on consignment, right? So those are all different revenue streams. And as Earl alluded to, they can have different implications. So it's important for you to drill down and really understand the different flavors of revenue that comes in. Also, as was mentioned earlier, accrual versus cash. The cash method of accounting records revenue when it actually hits the bank. The accrual method of accounting records revenue when it's earned, right? So when you perform that service and you invoice that client, you invoice them, that's booked as revenue. And you could have invoiced them in December, but you may not receive that money, that deposit in the bank until January or February. If your accrual method of accounting, you're going to record that in December. But if you're cash, you're going to record it in another year. So it's important for you to know that distinction as well as that timing. So also with this and a fine point, since we're kind of digging deep in, and also drop your questions, and if these discussions are helpful, please chime in as well. Uh, part of that as well is oh, so here we see with this business here, this business owner, the retainer fees from year to year, it increased, right? Revenue stream from project fees increased, and total revenue increased. What I was getting ready to allude to is if you invoicing your client, if you're not cash, not a cash business, if you invoice them, what are your terms? Is the invoice due on demand as soon as you invoice them, or are you giving them net 15, net 30, net 60? That's important to know the timing on actually when you're getting paid, because from a cost of sales perspective, you're still expending the money to offer that service and deliver that service or deliver that product. But if you're not getting paid 60 days later, that can create a timing crunch that you have to mitigate for.
Can I add something? I'm the
Sure,
banker.
sure.
Um, I actually always try to invoice my people to pay before they pick up their stuff
Nice, nice.
because I am using a product that I had to buy from the store ahead of time, plan my time, and then make the product. So then if it's a little different, like if someone doesn't show up for a meeting and my service is advice, like my service is a product that I already paid for, bought, made, took the time to make. So I always make sure that people pay before.
100% before?
Yeah.
Awesome. Okay, that's great.
Yeah.
Yes. So even if you can't get 100% up front, maybe have a 50% deposit or whatever. As much as,
Yes.
especially if if you're front loading costs and it costs you actually to produce that service before it's delivered, then it is
Right.
a good cash flow management mechanism to get something up front. Thank you for
Yeah.
chiming in. So that's
Of
Yeah,
good.
course. Yeah. Because there have been a few times where I haven't sent out my invoices and the product's gone out and I've looked at my account and I've been like, this looks lower than it should be. But it's because
Mhm.
I put out a product and I wasn't paid for it yet. So
Mm-hmm.
yeah.
Awesome. Great. Great. Thank you for sharing.
And
Anyone else?
for me, just briefly to add on to that, for me, I have multiple avenues of products slash offerings, depending on the product or the project or if I'm teaching a class or whatnot. Depending on that, I either charge 100% upfront or 50% upfront. It's not all one for some makeups of entities.
And how do you find what type of clients do you have, and how do you find, what is their receptivity to that?
So for instance, for the 100% down, those are my workshops, private lessons. There is involved in all of that is um, uh, the assumption that the person is actually going to show up. And so I'm working to be prepared for them to be there. And thus I charge 100% down. And for that kind of thing, people never say anything about why or question that. For the 50% down instances, those are more like projects that take longer periods of time, that have cost of goods involved, heavily involved, or some kind of commission where I have to, as the other person said, purchase product beforehand.
Mm-hmm.
And so I charge the 50% down, which I think for projects and long-term types of work, that's relatively common to get a percentage down. And I've never had so far, not that it's been a long time, but I've never had anyone question that.
Good. Awesome. Great. Thank you for sharing. Yeah, and depending on if you're offering service, so say if you have to travel to a client, cost of travel, especially if you're traveling out of state, air travel. Whew, whew, I could tell you about my nightmare this weekend with air travel. But those types of things, and lodging and things like that, those go into delivering your service for that particular client. I also have a client that runs assessments, like emotional intelligence assessments. She does some consulting. So those are like upfront costs that she has to incur to buy those assessments and deliver them to the client so that they can run them. And so it's important for her to, as been mentioned, receive a certain percentage of that revenue up front. So,
And it also depends on the competitive environment. So
mhm.
ideally, everyone would like to get 100%, paid up front. But if you're in a competitive business, and you require 50% when your competitors are, requesting nothing or 10%, it can put you at a competitive disadvantage. So the type of business that you have has a great impact on your ability to determine how much money you expect or you would like to get up front, which is always good. That is, that's the ideal. You're on top of the mountain if you can get 100%. But that may not be the standard sort of practice across the country because of for competitive reasons.
For sure, for sure. So oftentimes you have to test the market and see what works in your particular industry and for your particular clientele base. Great points.
And
Thank you.
particular project as well, as Fox mentioned that he charged 100% for some project, and so for some project 50%. So as well, it is depend on the project that you have.
Yeah, absolutely. So be flexible there, but know that each of those decisions goes into it affects your cash flow and the profitability of your business at any particular point in time. We talked about revenue. Let's move to gross profit because we mentioned that the revenue minus the cost of sales or cost of goods sold or cost of services is your gross profit. And in this particular business, the revenue is reduced by direct consultant compensation. So the consultants that she uses to deliver her services year over year is about 400,000 each year. And then there's some subcontractor fees that goes into her direct cost of sales. And as we mentioned before, there could be other, if part of your presentation is making printed materials available, that would be part of your cost of sales. We're talking about services, but if you're a product-based business, you know how much your batter and your milk and eggs I think we have a candle example, how much your wicks and your waxes and things like that. So your revenue minus cost of services is your gross profit, and a percentage of the gross profit divided by revenue is your gross margin. Okay, so revenue minus cost of services is the gross profit. Then you take that gross profit number divided by the revenue number, and that's your gross margin in a percentage form. Right. And so for this particular business, the gross margin held steady at 59%. Revenue held steady or grew by 12%. Right. Again, we'll talk about why she kind of felt tight, but in layman's terms, for every dollar that she received in revenue, 59% of that was kept after she paid 41 cents to cost of service. So 41% of revenue goes to delivering the services, and then 59% was left to pay the other costs that we will talk about later. And you can compare this. It's good, like we have here, year over year, but you can also compare to your industry. I know in the business planning phase, there's this software called space called LivePlan, and LivePlan helps you build your business plan, right? But it also, within the forecasting module, it has the ability to look at benchmark metrics. So you put in your industry, you put in your revenue, and you put in the type of business, and it'll tell you what other companies in that industry are doing for gross margin or gross profit percentage. Back in the day, we used to refer people to the Bureau of Labor Statistics. That's a government agency, and with the cuts to government, I don't know if that information is up to date. But the BLS, the Bureau of Labor Statistics, used to provide other industry data. If you're in other groups with those that are doing similar business to yours, if they feel comfortable sharing that, that's a way to compare what your metrics are to theirs. Or, in the day of AI, put it in Chat GPT, scrutinize those numbers, but say, I have this type of business, this is my revenue, what is some benchmark metrics or benchmark percentages for my industry? And it'll give you a number, and you can ask for it to cite its sources, and you can go from there. Any comments on gross margin or gross margin, that percentage and what it is across different industries? I know, for instance, restaurants have historically slim margins. It costs a lot to deliver, food in the restaurant industry. So they have to mitigate for that. But in other industries, if you have a service-based industry, you might have a margin of 50, 60, 75%, depending on, what your costs of services or cost of sales are. If you have a product-based business, that can run the gamut. So any other comments or questions around that? Just looking at that gross profit and that gross profit percentage or gross margin. It's important to know that revenue is not profit. And so we have Mr. Shark Tank.
Entrepreneurs or business owners, what advice would you give them to either scale or look for investors?
Don't. One of the biggest mistakes entrepreneurs make is they worry about the top line more than the bottom line. Getting to $1 million that feels good.
But if you're spending $1 million,
or yeah, if you're losing money or if you're hardly making any money, would you rather, hit $1 million and 5 million and 10 million and then be losing money because you're spending it on growth? Or would you rather do 800,000 and put 200,000 in your pocket and then use that money to figure out how to grow more profitably? And so the biggest mistake they make is focusing on sales over profits. Man, unless you are absolutely positive, you don't want to borrow money to start a business because it goes from being your business to the bank's business. And the bank wants that payment back. And if you don't pay it back, you're done and it's over.
So Mark's talking from like a high level venture capital perspective, but the gist of that is just trying to help you to know that revenue is not profit. People, can oftentimes, in my circle, we say revenue's for vanity, profit is for sanity, right? So revenue, they like kind of boast of that big revenue number, but how much are you spending to produce that product or service, and then how much is left over at the end of the day, right? So revenue is not equals profit. So it's important to know the distinction between that and what drives those. This is a simple example of a product-based business. The sales price is $40 for the candle. The cost between the wax, the jar, the fragrance oil, the packaging, direct labor is $25 per each. And so the gross profit per product is $15. And that's a 37.5% gross margin.
And that's important. That goes to your last point regarding gross margins, right? Goes to Mark's point. So if you're on the top level revenues and you ultimately have a gross margin, right, of 5%, it gives you some indication, on a direct cost perspective as to whether or not this business is profitable. So again, to your point, which was very good, gross margin is important because it gives you some indication of your path toward ultimate profitability.
For sure. And if you have an exit strategy in mind and you're looking to eventually sell your business, most of the time, those that may be looking to buy your business, they want to know, what does it cost you? That gross profit percentage, that gross margin is super important because the fixed costs, they can change it, they can move the location, they can work with all those other fixed costs. But what does it actually cost you to deliver your goods or your service? So it's key and critical to drill that down and know what drives those numbers either up or down. We looked at a product-based business. This is a service-based business that similar to what we were talking about earlier. These are the specific costs that may go into cost of sale for your type of business. And if you can think of any others for service-based or product-based business that goes directly into your cost of sales, I'd be willing to chat and hear from you. But knowing your cost of sales is key to understanding true profitability. That's gross profit, gross margin. Now, underneath that, you'll see it in the handout. We have it here. These are more so your operating expenses, maybe called fixed costs. These are the other costs that are involved in running your business. And maybe we'll get to it. We're going to talk about break-even point as well, right? Using that fixed cost, using that gross profit margin, and figuring out what point is going to actually take you in terms of a revenue target to actually not lose money, to be at zero and then start to make money. But when we talk about operating expenses, salaries, other salaries and wages, rents, utilities, softwares, marketing, professional fees, insurance, depreciation, miscellaneous. As a former tax auditor, that miscellaneous was always scrutinized for us. So be careful what you put in miscellaneous, right? You want to make sure you know what's going in there, right? But these are the other costs that it takes to run the business. And in a service-based business, salaries is usually going to dominate as far as the cost and percentage. Now, with AI, they're saying that, we're going to be replaced by chatbots or what have you. But as of right now, we actually, use people all right, to deliver our service. Generally, typically, we can leverage AI, of course, but typically that's salary. What it costs you in terms of salaries, but also benefits, right? If you have full-time employees and you have to offer benefits and different things like that, that's going to go into the people costs of your business, and that usually would be a large line item. So if you're looking at metrics, yeah, definitely nail down your gross margin, but also take maybe your largest line item, right, of your P&L and measure that as a percentage of revenue and see how that changes and see how that moves from time to time, right? And see how that's impacted through the relative seasons of your business. Every expense. So for this particular business, every expense category grew year over year, but it was proportional, right? So there wasn't any big um, changes in the expense categories, disproportional changes in the expense categories. But for your particular business, it might be good to look at that. So if in one particular year you spent money on marketing, you invested heavy in marketing, maybe in running ads, or maybe in building out a website, or maybe in lead generation, right? And so you want to know, all right, yes, I see the cost, but what was my return on investment? Based on that increase in cost, how much did my revenue increase? Was it proportional? Did I get some money back on that? Or maybe you revamped your whole technology side of your business. All right, you saw that increased, but how did that impact your revenue? So this is how we can kind of use and drill down on these numbers and see how it affects the overall well-being of your business, and use these numbers to make business decisions. It kind of is a objective decision maker, right? So if I'm really keen on, hey, I really wanted to invest more in these ads, but if it's not paying off in revenue, then maybe I have to find another way to market my business. Make sense? Then we had gross profit. We reduced it by operating expenses, and we had now operating income. So sometimes depreciation is dropped under here with interest and expense, or depending on the presentation, it could be different. But once you pay all of those expenses, you're going to get net income, right? And then you take that net income as a percentage of your revenue, and that's going to get you your net margin. So for this particular business, it stayed consistent 7%, around 7% each year, while net income actually, the revenue grew, right? The net income grew 12%. Shows efficient scaling. So if you were looking at these numbers, and if this was your business, and if you were consulting or talking and discussing these numbers, or looking at it yourself, would you say that 7% net margin, is that a good net margin? What would you compare it to? Any discussion around that? First, it's good to make money, right? It's good that you have money left over, but how does that, is a net margin of 7% good for you? What does that mean to you in terms of numbers, right? 78.2. So you'll be paying tax on 70. And year 3, it was 78.2. And in year 4 is 87,400. And again, this is outside of the scope of what we're talking about, but depending on your legal structure as a business, these numbers could be taxed very differently.
Right. It also shows, oh, what was the revenue growth?
The
Was the
revenue grew, I believe it grew 12%. Let's go back. Revenue grew 12%. Yep.
Right. So revenue grew 12%.
Mm-hmm.
The actual net income margin nominally declined because it was 7.1% and it
Mm-hmm.
went to 7%.
Mm-hmm.
So, I mean, as I look at overall efficiency and profitability, you're not necessarily getting a bang from the buck. So you grew 12%, your profits nominally decline. And normally when you grow your revenues, you would expect, if there's some efficiency improvement, right, in
Mm.
the expenses, could be in your direct or operating expenses, you would expect the margin to increase a bit. That would be my observation. Just, I could be
Good,
wrong, but that's,
good point. Good point. Any other thoughts or observations on that? Cool. Um, we can quickly talk about a break-even point. You take your fixed costs. You remember those are those other operating costs, and you divide that by your gross margin. And this should be in your handout. Maybe it's in your handout as well. I'm not sure. But you take your fixed cost divided by your gross margin percentage, and that's going to give you your break-even revenue number. I think we have the numbers broken out here. Yeah, so for this business here, the fixed cost in year 4 was 645,000. The gross margin was 59.3 percent, and that gives us a break-even point of about a little over 1 million. And we know from the financials that the actual revenue was 1.2 million. So they, of course, were profitable. But that break even point will help you to know at what point you're actually able to pay all the bills and you're not at a loss, and then at what point now you're going to start to make revenue or profit, right? Profit. And then also you could break that down. So say if the revenue number was 1 million and you knew that it cost you, so 1 million, so say $1 million annual revenue, that's about 83,000 monthly revenue. And say your average consulting client pays you about 12,000 per month. That will let you know 83,000 divided by 12,000 per month will let you know you need about 7 clients paying consistently per month to break even, if that's your business model. So you can use that number, use your break even point, use your target break even revenue to kind of reverse engineer what you would have to do in terms of sales to hit that break even point. And then if you know what it costs you to either acquire new clients, then you can decide whether it's worthwhile to invest in getting more new clients. Or if your market or if your clients can sustain it, would you have to maybe increase the price that you're charging? If your clients can sustain it, increase the revenue and get to that place where you can meet those target revenue numbers. So the break-even point is a good tool to help you to know where you are in terms of that point where you start to make money. I'm going to drop that handout in the chat one more time as requested. And we'll send these via email as well. Thoughts on the break-even point? Do you as a business owner know your break-even point? Have you computed that? Be interested to know. Anybody in the audience know their break-even point? Have you run the numbers before?
I've done mine before.
Okay. Did it surprise you or was it pretty much what you knew?
Kind of. It's also interesting too because I had to make sure I didn't count the days we were closed.
Ah,
So I had to subtract 8 days out of the month. So I figured out what I needed to make daily between my walk-in customers and my custom orders. So it
great.
definitely is very helpful.
Great point. Because if you have
Yeah,
walk-ins, then you have to know, all right, what is the normal foot traffic around here?
right.
And
Like
will
I
I get enough
know
foot? Go
the
ahead.
weekend's going to be busier.
Yeah.
So if I feel like the numbers are a little low, then I know that I need to do something special for the weekend to try to drive more people in, or I need to send out an email to my customers. You haven't ordered in a little while. Like, here's what we have. So
I
it's definitely
love it.
helpful to know how to also market yourself and when you need to.
Absolutely. I love it. So you do really love the financials. Okay, I love I
No,
like
he was kidding. Oh my gosh,
it.
no, he was kidding. I couldn't unmute myself fast enough to laugh at the joke because I almost never send Emil over my financials and I really need to. So that might have just been his way of reminding me.
But at least you know what's
At
going
least
on
you know
behind it.
that. I'm glad to hear this, to be honest with you. That's great.
Yeah, thank you.
Yeah, that's super. Yeah, so it's like it's so key. It's so key and critical to know like what it takes you to hit your certain targets, and then like you said, if you have a different business mix on online versus in person or foot traffic sales, then you have to know how many people got you have to sell to, and then if you break it down on cost per or sale per customer, then you know how many customers then you need in a particular day, right, or a particular week to reach those goals. It's a powerful tool to really use in your business. So if you don't know it, we're giving you the tools to be able to compute that on your own and run the numbers and see how that impacts you and your operations. So we got some no's. So no, not yet. No, I haven't. No, but looking into it, I have a question. If I have to pay royalties to a franchise, how do I calculate this in the break-even point? So are your royalties based on sales or is it a fixed cost? Ilka.
So I guess I can unmute, but I'm actually using my wife's profile, so I'm not Elka, but I'm Yvette.
Sorry.
That's no, it's on me. I don't know how to change her face, and I don't want to really. Um, I guess I can take off video. So there I am.
Hey.
It's based on sales, and then they break it down by type of sale. So
Yeah.
if I'm doing restoration work or any services that they kind of oversee, it's a certain percentage, and then if it's not that, outside of that, it's still a percentage, but a different percentage. And so I'm just wondering where that lives in the break even calculation.
Yeah, if it's and this is my perspective, and others you can chime in. If it's based on revenue and based on sales, I would put it into that cost of sales number. So I would treat it like commissions. Like I would put it in that revenue minus cost of sales to get that gross profit number. That's where I would put that there to determine your gross margin. And then the fixed costs are usually those that really don't change, right? You're basically the same month by month, typically the same month by month. So I would use those royalties as part of the gross margin, but I'd be willing to hear what others have to think about that. Agree or disagree?
I have a thought.
Go ahead.
So I have to pay a meals tax to the state every month, and it's always different. It's a percentage of what we sell. And so I have a second bank account that I have for just meals tax. And so then at the end of the month, I already know like exactly what I have to pay because every day I move the money over into that other bank account.
That's a great practice, first of all. Yeah, I'm a profit. I'm
Yeah.
certified in profit first methodology, and we like to use the different bank accounts for the different things.
Yeah, I
Um,
found it very helpful.
Yeah, and having a separate count for the taxes, particularly the meals tax, I think is great. But because the meals tax is based on revenue, I still would put it under the gross margin percentage.
I think so too. I would agree with your assessment. It sounds more like a gross revenue, um, gross profit type of item.
Yeah, that's what I would say. Even
Thank
though
you.
you have a fixed amount that you're moving over from a cash flow perspective, that's different from a profit perspective, right? So from a profit perspective, I would use it as uh, I would put it on your gross margin. Emil, I know we're getting close to time, so I don't want to go over. But I'm open to any questions, last minute questions.
Any question?
Oh. I would also say, just following up very quickly on your last comment, um, part of financial sort of wellness, if you will, is that it's iterative. So you may not create the perfect model initially, but you improve on them. You get better data, you get better information. So I would not emphasize being perfect
Yeah.
although we want to be perfect,
Yeah.
because things change and you have to adjust. The adjustment is the most important part. In my,
That's a
yeah.
fantastic point. Because even when we use something like Profit First, we work business owners through that methodology with using the separate accounts and segmented certain percentages to certain accounts each month. We know that in real life happens. So it's not set in stone concrete. You have to be flexible. Any system that you have to be flexible. And that's just an absolute, in business in general, it's great to be flexible. This climate today, like who would know that all these different things would converge all in once? Who could predict it? COVID-19, right? So you have to be flexible in that. Um, Emil, I don't know.
Yeah.
I have these
So
are the final points, takeaways, but I'll throw it back to you, Emil, if you have any closing remarks. And you all are going to
thank you
get the
so much.
slides and the handouts.
So you would say this is what I want to ask. You would send the slide and the handout, and I will email them to everyone here in this room. I just have Anita, if you want to answer her question, why not use the sales number without the tax added?
Yeah, I was wondering, Katisha, because when we work with people that collect sales tax, because the POS systems are so sophisticated, is it not a better practice to just use the sales number without the tax?
As far as determining the gross margin, or
Yeah,
are you?
yeah, because it's not our money anyway, the tax rate. I mean, like let's say Allison sells a cake for $40 and that ends up being, $43, for example. It's technically a $40 sale, is it not?
Yeah, I hear you. That's a good point. Yeah, and so yeah, whatever works best for you. If the system that you're using doesn't allow you to drill down to get those sophisticated numbers, using the sales number is going to get you to where you need to be as well. So
Okay.
yeah, I think that would be as long as you have the other cost that goes into selling your product or service as your cost of sales, then I think you still have enough information to get the roundabout accurate figure.
Okay,
Sure.
thanks.
Mhm.
Okay, thank you so much. I will stop the recording.
Next time we're talking about balance sheet, and if you can, each class is on its own, but if you can, I'd love to have you come back to talk about balance sheet, and then the week after that is the statement of cash flows.
Yes, I will keep sending the emails, the reminders, but you can use the same Zoom links as well. But we would love to see you again, please.